welcome. In this video, we will look at the short straddle trade. You may remember from my video on the long straddle that for a long straddle trade, a trader buys two options on the same stock, a long call and a long put, both at the same strike price and time of expiration. For a short straddle trade, instead of buying both a call and a put on the same stock, the trader sells two options on the same stock, a call and a put, both at the same strike price and expiration. Selling both a call option and a put option creates a range around the current price. If the price of the underlying stock remains within that range, the trade is profitable. In other words, the trade is profitable if the price of the stock does not go above a certain price or below a certain price. The profit or loss from this trade becomes the difference between the upfront premium that the trader is paid for selling the options and the amount that the underlying stock increases above or falls below the strike price. If the price of the underlying stock is exactly at the strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless and the trader keeps the full premium that he was paid up front for selling the options as his profit. The full premium that he was paid up front is his maximum possible profit for this trade. If the price of the underlying stock is not at the strike price, one option still has no intrinsic value at expiration and still expires worthless. However, the other option does have intrinsic value. This means that the profit the trader made selling the options declines by that value. If the price of the underlying stock is above the strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the current price of the stock and the strike price. If the price of the stock is below the strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the strike price and the current price of the stock. If the price of the stock is above the upper break-even point, the loss on the call option exceeds the premium the trader was paid for selling both options, resulting in a loss on the trade. If the price of the stock is below the lower break-even point, the loss on the put option exceeds the premium the trader was paid for selling both options, also resulting in a loss on the trade. Often a trader will place a short straddle trade with the intention of closing the trade before the options expire by buying back the options for less money than the amount that he originally sold them for. Sometimes a trader will sell the options for a short straddle when implied volatility is higher, which drives up the price of the options, and then buy back the options when the implied volatility and in turn the price of the options decreases. For instance, sometimes a trader will sell the options to open a short straddle trade before an earnings report or economic report. The theory is that the expected result from the report has already been priced in. In other words, the price of the stock has already made the move ahead of time that will be generated from the report, providing the results of the report are as expected. The trader will sell the options heading into the report when implied volatility is still higher, and then buy the options back after the report is released when the options have dropped in value from both the decrease in implied volatility and the decay from the shrinking time left until the options expire. Let's look at an example using GLD, the gold ETF. At the time of making this video, GLD is currently $129.09 per share. A trader could place a short straddle on GLD by selling the $129 call option and selling the $129 put option that both expire in about 6 weeks. The call option costs $2.54 per share, and the put option costs $2.46 per share. Selling both means that the trader collects a total of $5 per share up front for selling the options. This means that for the trade to be profitable, the price of GLD must remain within $5 of the $129 strike price. In other words, for the trade to be profitable, the price of GLD has to remain above $124 and below $134. The $5 premium the trader was paid up front for the options is the trader's maximum potential profit. If the price of GLD is at the $129 strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless and the trader keeps the $5 he was paid up front. As the price of the stock moves away from the $129 strike price, one option still has no intrinsic value and expires worthless. However, the other option does have intrinsic value. This means that the profit the trader made selling the options declines by that value. If the price of GLD is between the $129 strike price and the break-even points, the trader's profit will be between $0 and $5 per share. If the price of GLD is above the $129 strike price, the trader's profit or loss is the $5 premium that he collected up front selling the options, minus the difference between the current price of GLD and the $129 strike price. The upper break-even point is $134, so if the price of GLD is above $129 but below $134, the trader's profit is between $0 and $5. If the price of GLD rises above $134, the trade loses money. If the price of GLD is below the strike price, the trader's profit or loss is the $5 premium that he collected up front selling the options, minus the difference between the $129 strike price and the current price of GLD. The lower break-even point is $124, so if the price of GLD is below $129 but above $124, the trader's profit is between $0 and $5. If the price of GLD falls below $124, the trade loses money. So that's the short straddle. I hope you enjoyed this video. Thanks for watching.